There's a couple cross currents in the markets as a result of inflation being persistent, but also geopolitical conflict being high and the implications of higher commodity prices. And the conundrum the market's facing is inflation versus growth. Central banks have been focusing on inflation, talking hawkish, rhetoric hawkish, to cool inflation expectations on a go-forward basis. And the result of that in bond markets, particularly government bond markets this year, has been starkly higher yields, lower bond prices in government bond markets as those markets recalibrate to an expectation of a very hawkish Fed. So simply put, government bonds have had a tough start to the year, a negative performance as a result of central bank and the Fed focusing very hawkishly on inflation, hawkishly on inflation, and bringing government bond yields up to price for that hawkish directionality. I think this environment is still conducive for corporate credit, for corporate debt, and if you look at credit fundamentals in some of the markets, they're healthy. Look at areas like the high yield market, where you could say, oh, these non-investment grade companies arguably the most vulnerable to weaker growth. What do their leverage metrics look like? What does their debt serviceability look like? And all of that's been stable to improving over the last couple years. You've also seen improvement in the borrower types in some of these markets. So I'll take the high yield market in the US as another example. Over the last decade plus since the GFC, you've seen that market migrate to more and more double B issuers, so the highest quality ends of the high yield market, versus its historic past where there was more triple C issuance in frothy periods of the market, or more leveraged buyout type of issuance in debt proceeds. Today it's solid double B names, household names like Netflix that are in that space. And what are they using debt for? To refinance and use in their operations. So I describe the overall metrics as healthy. The last point I'd make is if you boil that all into, well, what do we expect for defaults on a forward-looking basis? Still expect that to be pretty benign. So in the US high yield market this year, 75 basis points of default expectations forward-looking. Next year, maybe it goes up a bit to mid 1%, but still well south or well below the long-term average trends in high yield for defaults. One point, but that's a manifestation of the U.S. economy, for instance, is slowing, but our base case is not one of a recessionary risk on the foreseeable horizon. So Europe definitely, compared to the U.S., more vulnerable to the impact of commodity pressure and commodity prices and the implications for growth. So certainly the slowdown in Europe is more stark than the U.S. What are the mitigants to the slowing growth? We'd point to fiscal. There's a lot of fiscal spend taking place in Europe right now. Take Germany, for example, with its additional military spend coming. These are multitudes of what the countries like Germany have spent in the past on fiscal. So not only are we talking about big numbers, but good tails that will support growth in the out years out of Europe. So it's going to be stop and go for Europe, but I think fiscal can help mitigate some of that slowdown.